Real estate investment presentation, housing bubble. Get ready because we're raising the stakes with real estate. Like with any market, the housing market does develop bubbles from time to time, bubbles that will increase over time, bubbles that will eventually pop at some point in time, resulting in prices that would be greater than evaluations at certain points in times and resulting in house prices that could decrease at certain points in time. We have an idea and we're comfortable with bubbles to some degree with regards to the stock market, expecting the stock market to go up and down from time to time, could have large swings if you're investing in the stock market. The idea, however, being in the long run that hopefully those average out, so the long-term trend will generally be an upward trend, although those ups and downs, those bubbles increasing and decreasing, can be quite severe at times. But even in the stock market, when there's a long period of good economic growth in the stock market, we start to feel like this is the new norm. This is just how it's going to be. We should have all our money in there because it's going to go up forever. The Federal Reserve has figured it out at this point. It's never going to go down again until it does, because that sentiment itself helps to kind of fuel the bubble that is over optimism that will eventually drop at some point. Now, this kind of trend can be even more dangerous to some degree with regards to the housing market and real estate, because when we invest in real estate, especially as individuals, the distance between the bubbles, the declines that can happen, the bubbles bursting, can be longer, meaning there might be a longer distance between the prior decline in the housing market or a housing bubble bursting to the next one, and therefore we have a much longer time frame where we're sitting there saying, hey, this is the new norm, things are never going to go down anymore, and therefore we don't factor in the risk as much as we otherwise would. Also, because housing is such a big part of the economy and it's such an important thing to individuals in terms of their individual homes, there could be government incentives to kind of extend the housing bubbles, and we get this idea once again that basically they figured it all out at this point in time. There's not going to be a bubble anymore because now they're going to support and figure the whole thing out, which of course again leads to the sentiment that increases the bubble. It's also something that could be a large investment for us, especially as individuals, and it's one where we often leverage highly on, meaning we take a lot of debt in order to invest, say, in real estate. And if that pays off, that's really good. If you leverage something and invest in it and it pays off, meaning the market goes up, then we do quite well because we were able to get a return on something far more than we could originally invest with our own resources. We took a loan out and invested it. And so if things go well, that's great. But if you're over leveraged and things go down, then that could be very bad, right? That could be a bad thing with regards to our investment. It can amplify the losses that we would otherwise have because once again, we invested more, we leveraged in order to invest. So hopefully things go up and everything works out, but we got to keep in mind the fact that housing markets do go down from time to time, and we want to get a sense of where we are with regards to any kind of overvaluation or any kind of bubble that might be involved. We want to see that from both, again, a national standpoint and try to say, are things overvalued on the national level? And then think about it on the local level and think about where we stand in terms of the local level, because people are always going to need housing, of course. The question is in terms of valuation. Where are the valuations overvalued and undervalued? And are we at a point in time where there's going to be an increased level of risk due to the fact that we think there's going to be a bubble? And again, you got that long-term sense where the bubble might play itself out over the long term, but that could be quite a long ways. If there's a housing decline in a certain area, it can take a long time for that decline to even or average itself out over time. Also note that if you're purchasing in order to live in the area for a long period of time, it might not be as concerning whether or not you're in a bubble or not, because you're saying, hey, look, I'm going to be here. I'm putting my stakes down. This is where my roots are going to be. And if there's a decline in the housing, even if my mortgage goes below the value of the house, if I'm underwater on it, I'm still paying it off. I could still make the payments and I'm where I want to be. It's not the end of the world. It's painful to see that happen, but not the end of the world. If you're investing and flipping homes and things like that, then of course it's possible to get caught over leveraged and so on if the bubble was to break at some point in time, and that's when the risk would be higher as well. Okay, so we're going to take a look at here, and we'll look at the prior the big bubble that burst, that was the housing decline that caused like kind of the Great Recession decline, just to keep that in our mind, because that's the most recent kind of big decline that we can take a look at just to get an idea of it. And again, you want to take that idea and apply it to both the national and local level. We're going to be referencing Investopedia by Hans Daniel Jasperson, Investopedia being a place you can go to look up investment-related terminology, continuing your research from there. So a housing bubble or real estate bubble is a run-up in housing prices fueled by demand, speculation, and exuberant spending to the point of collapse. So if you're in a situation where everybody is basically saying nothing could ever go wrong, things are going up, the market, we figured everything out, the government is supporting everything at this point in time, they won't let anything go down, those are all sentiments that are too good to be true. And if they're all compiled onto each other, it creates an environment where everybody wants to invest at that point in time, and the prices are going up, over what you would think. Now that could last for a long time. You might be able to make money in the short run as the bubble continues to blow up, and you never know when it's going to pop, because again, these things could last for quite some time. But you can tell when you're in that environment, things don't seem quite right if everyone is just way too positive. So housing bubbles usually start with an increase in demand in the face of limited supply, which takes a relatively extended period to replenish and increase. Speculators pour money into the market, further driving up the demand. At some point, demand decreases or stagnates. At the same time, supply increases, resulting in a sharp drop in prices, and the bubble bursts at that point in time. So a housing bubble is a temporary event, but it can last for years. So remember, again, the bubbles from a stock market standpoint, if you were to invest in, say, stocks for your retirement, and you were to invest over a 15 to 30-year horizon, you're expecting the market to go up and down, bubbles to go up and pop. But over the 30 years, you're expecting there to be an increase. You can have the same kind of concept with regards to housing. But with housing, those bubbles could last for quite some time with regards to a decline from a bubble bursting from real estate in a particular area. So it could be a longer time frame before the things average out over time. So usually it's driven by something outside the norm, such as manipulated demand, speculation, unusual high levels of investment, excess liquidity, deregulated real estate financing markets, and extreme form of mortgage-based derivative products. And so these are some of the things we'll talk about a little bit that kind of drove the Great Recession in terms of housing declines. And some of it's going to be incentivized, of course, by the government. So the government is going to be saying, hey, look, if there's a problem in housing, then that could be a decline in the economy. That's bad for politics and so on and so forth. So they tend to try to extend things, which could actually lead to increasing the bubble by making financing more easy and so on and so forth, which will actually result in people not, taking out financing, which they shouldn't be taken out generally because they're not likely to be able to pay it off, and so on. So we'll talk a little bit more about those kind of things. As you see the pendulum swing, as things rotate around, you'll see these things come back up at some point in time as kind of a solution to the problem, which might just, again, kind of extend the bubble. So all of which cause home prices to become unsustainable. So it leads to an increase in demand versus supply. According to International Monetary Fund, IMF, housing bubbles may be less frequent than equity bubbles, meaning the stock market, but they tend to last twice as long. So again, they can be, the time frame between them could be longer, which can be bad because you start to feel like you're in an environment where things will never go down again. Remember that time when things were bad? That's never going to happen again. It's been forever ago. We got it figured out now. But then when it goes down, it could take twice as long to basically get back to the equilibrium. So that risk is something we have to take into consideration, of course. Housing bubbles don't only cause a major real estate crash, but also have a significant effect on people of all classes, neighborhoods, and overall economy. They can force people to, so obviously these housing bubbles, you can see it in economies around the world when they start to say that they got these housing problems or these declines in the housing bubble. It could drive larger economic problems as well because it could be quite significant. They can force people to look for ways to pay off their mortgages through different programs or may have to dig into retirement accounts to afford to live in their homes. Housing bubbles have been one of the main reasons why people end losing their savings. So traditionally, housing markets are not as prone to bubbles as other financial markets due to the large transaction and carrying costs associated with owning a home. So traditionally, if you own a home and the banking terms, the bank usually is looking out for themselves, right? They're trying to make interest. And that's why they basically charge the traditional kind of terms, which is, I would like you to give me 20% down. I'm going to have the house as collateral. Even if the house goes down, the market, the bubble bursts and it goes down by 20%, I'm still okay on my loan because we can cover that. But when you start to make things complex, like for example, the lenders being able to sell their loans on the secondary market to quasi-government entities like Fannie Mae and Freddie Mac, who don't have as much incentive for their personal incentive because they could basically cover themselves with tax dollars if there's a problem, then you've got situations where the bank is not, is possibly likely to take out loans that are more risky because they're just going to sell them maybe on the secondary market or something like that. So if you get financing situations where they're not taking 20% down and so on and so forth, then if there's a housing decline, that can lead to problems. It's some of the things that kind of took place. So as you see those kind of incentive programs that come into place to incentivize housing and incentivize banks to act certain ways, in the long run, that could be causing a bubble, right? So, however, a rapid increase in the supply of credit leading to a combination of very low interest rates and losing of credit underwriting standards brings borrowers into the market and fuel demand. So again, through possibly government incentives, possibly secondary sales of the mortgages to quasi-government entities like Fannie Mae and Freddie Mac, then you see banks being incentivized to take other actions. You can blame the banks. The banks have blame, in the Great Recession and this and that as well. But obviously they were incentivized in many ways to kind of take on these loans and then sell them. And so now you've got situations where the banks are basically possibly giving loans out which are more risky than they otherwise would have been. And you would think we'd learn our lesson from that, but every time, in order to prop up the housing market, these are the creative thinking ways that people come up with to do that. And it's really, no matter what you do, it's distorting the market and possibly causing a bubble. So a rise in interest rates and the tightening of credit standards can lessen demand, causing the housing bubble to burst. So the infamous U.S. housing bubble in the mid-2000s was partially the result of another bubble, this one, the technology sector. So we'll go into a little bit about this, the big bubble that burst here, and you have similar bubbles that you can have in Japan. Had a bubble like that. You can argue that there's bubbles like in China that they're having with relation to housing that can kind of drag things out and stagnate the economy and so forth. So this is the one in the U.S. that's recent and important that people are going to spend a lot of time kind of looking back on and say, hey, what went wrong? How did we not see this kind of thing? So it was directly related to, and what some consider the cause of, the financial crisis of the 2007 and 2008 when there was like the Great Recession. So during the dot-com bubble of the 1990s, many new technology companies had their common stock bid up to extremely high prices in a relatively short period of time. So this was another bubble. This is going to be the market bubble on the market side of things. And again, the same kind of thing happened, right? There's a new norm. These dot-com companies can do no wrong. They're going to go up. You just put money into them and they'll just blow up and you'll make a ton of money. It's kind of like the Bitcoin thing and the cryptocurrency. I'm not against cryptocurrency or anything like that, but you get this kind of good, this thing is good, nothing can go bad with this kind of thing. And that sentiment in of itself will drive the bubble. So even companies that were little more than startups had yet to produce actual earnings were bid up to large market capitalizations by speculators attempting to earn a quick profit. By 2000, the NASDAQ peaked, and as the technology bubble burst, many of these formerly high-flying stocks came crashing down to drastically lower prices. As investors abandoned the stock market in the wake of the dot-com bubble bursting and subsequent stock market crash, so now you had that bubble bursting, where are people going to put their money, right? You got people now with money, and they're saying, I no longer trust the market. It crashed. Where am I going to put it? They moved their money, in essence, to real estate. So now you got real estate, which is basically soaking up this money in an extreme way, which again could cause and the shift of a bubble possibly potentially forming then in the real estate. So at the same time, the U.S. Federal Reserve cut interest rates and held them down in order to combat the mild recession that followed the technology burst. Now, here's what the big issue with regards to the government. That's always going to be an issue, right? They're going to be fluctuating the interest rates. What are they doing with the interest rates? They're keeping the interest rates down to zero forever. Is that possible? Can you really do that? Is there really a new economic theory where, like, you can just not have interest or something like that? So, it seems kind of funny if you have extreme government intervention for kind of a long period of time. You would think that would fuel the economy to form a bubble in some kind of way, somewhere, in some way, shape, or form. So as well, this flood of money and credit met with various government policies designed to encourage home ownership and a host of financial market innovations that increase the liquidity of real estate-related assets. So now there's also been incentivization, part of it from a political kind of standpoint, basically saying home ownership, is the American dream and so on and so forth. We're incentivizing people to be able to participate in that more by incentivizing home ownership, partially in ways to put pressure on the bank, have a secondary market, having a huge role with Fannie Mae and Freddie Mac and so on and so forth. So home prices rose and more people got into the business of buying and selling housing. So this, of course, led to not just people being able to live in a home and purchase home. It led to more people getting into the business of real estate, doing things like purchasing homes and flipping the homes, buying the homes, turning around and selling the homes. The idea, of course, there being that the homes are now incentivized to go up and up and up forever, which you could see is kind of a bubble. But again, as that bubble increases, then you can make money as the bubble is going up by basically buying the property, leveraging it heavily, and then selling it shortly and making a profit in on it. So you can do that mindfully possibly and try to get in and make that work before the bubble bursts, seeing that basically the government policy is invested kind of in the increase in the bubble. They don't want it to burst. They're going to extend it longer. But you have to keep your eyes open and be willing to accept the fact that you don't know when the bubble is going to burst, because nobody does. And if you get caught in a highly leveraged situation, then that's when the problem, of course, is going to be there. So you want to make sure that you're taking on the proper risk assessment with whatever your strategy would be. So the U.S. housing bubble, and also note that this is housing bubble. Of course, we're talking about basically a national level housing bubble. That doesn't mean that on the local level and the local level that the housing bubble situation can be different. There's always going to be opportunity in housing, somewhere. The question is, what's going to be the national trends? What are they doing with regards to financing? How's that going to affect the economy overall? And then how can I leverage that knowledge to where I want to basically put my money and basically invest? What is different about the local niche that I've got around here? So over the next 6 years, the mania over homeownership grew to alarming levels as interest rates plummeted and strict lending requirements were all but abandoned. So basically, people were taking out loans with very little requirements, because you would think you go to the bank and you're saying, yeah, I could. So you're telling me I could just take a loan out for the entire value of the home that was appraised, that just went up like by 20% over the last year, and I don't need to give you any kind of backup or support about my credit rating and this and that, barely. And they're like, yeah, that's fine. And that kind of thing going on. And you're like, well, why would that happen, right? Because, the bank is thinking that they're going to basically package that loan together. That's when you get those derivative securities and whatnot, and then sell it someplace on the secondary market. So they're trying not to get stuck with it. So they're able then to take on loans, which they never would have taken on if they were actually stuck with the risk of taking on those loans. And you could see they're just passing it down the road. Who's eventually taking on that risk? If it eventually gets to Fannie Mae and Freddie Mac, then partially quasi-government entities are basically taking on that risk, which again, they're not market interested, right? They can be supported by the tax dollars. That's why things can kind of fall apart at that point. So it is estimated that 20% of the mortgages in 2005 and 2006 went to people who would not have been able to qualify under normal lending requirements. So now you got these loans going out to people that probably wouldn't qualify for them. And again, if they were investors that were well aware of that, and you're doing that in a way in order to generate revenue, and you're aware of the risks and so on, then that would be one thing. But of course, if you're not aware of those things and you're saying, well, this is the new norm, the government wants me to buy property, they're telling me to do it, they're giving me free money to do it, and you're taking on debt, not understanding the risks involved with it, then that's of course another story, and that's a problem. Usually you would think the bank would be a safeguard against that, because if the bank was acting in a self-interested fashion, they wouldn't give loans where they didn't think that the borrower could pay them back. But again, the banks they are acting self-interested, but they now have the secondary market where they can basically dump these debts, and they're being incentivized to take on these loans in some ways to do that. So over 75% of these subprime loans were adjustable rate mortgages with low initial rates and a scheduled reset after 2 to 3 years. So now you've got these, they called them at the time like innovative lending practices. It's where, again, it was kind of marketed as if these are new things, these are new kind of lending terms that we've never thought of before, and they're going to innovate the market at this point in time. Whereas, they're not kind of lending terms we haven't thought before. They're deviations from the standard, which can be appropriate in certain periods of time if both the lender and the borrower are aware of the risks and the rewards that could be assigned with that type of loan. But again, the idea, the kind of feeling at the time was, well, the government wants me to take out the loan. They're incentivizing the banks. The banks want me to take out the loan. I got tax incentives for it. They got these new innovative loan structures. So, everything's lined up for me to do this. So, and again, that sentiment can kind of fuel, of course, a bubble. The government's encouragement of broad home ownership included banks to lower their rates and lending requirements, which was spurred a home buying frenzy that drove the median sales price of homes up by 55% from 2000 to 2007. The home buying frenzy drew in speculators and began flipping houses for tens of thousands of dollars in profits in as little as 2 weeks. So again, as you see these prices go up dramatically, that of course doesn't just incentivize people that couldn't buy homes before to live in to buy homes. It also incentivizes people to make a quick profit by purchasing the homes and taking advantage of this rapid increase in prices by simply just selling them, even if you didn't fix them up or anything, right? The market's going up so fast, you could just buy them and then basically turn around and sell it. Obviously, that can't last forever. Obviously, there's something going on. But obviously, too, you can make a short-term profit if you get in before the bubble bursts. However, there's a lot of risk involved in that. During that same period, the stock markets began to rebound, and by 2006, interest rates started to tick upward. So now you've got finally the interest rates basically going up. At some point in time, the Federal Reserve is going to have to say, hey, look, if inflation's going to become a problem, we got to tighten this thing up at some point in time. Interest rates will basically increase at some point, you would think. So adjustable rate mortgages began resetting at higher rates as signs that the economy was slowing emerged in 2007. So now when people had those adjustable rate loans, which had these very low rates, possibly they had very little down at the same time that they put down up front. And so now you got a situation where they're going to be paying the higher rates, less likely to be able to pay off the loan. Also, they probably took out the loans in a situation that it was more risky than they otherwise would have been able to due to the lending standards being more lenient. So they're much more likely not to be able to pay off the loans at that point in time. With housing and prices teetering at lofty levels, the risk premium was too high for investors and then stopped buying houses. So now at that point in time, investors are saying, all right, the bubble is starting to burst. We're not turning the profits that we were anymore. Stop buying. When it became evident that that home values could actually go down, housing prices began to plummet, triggering a massive sell-off in mortgage-backed securities. So again, now this situation, of course, now you're at the peak and people are realizing that, hey, this could actually go down. Housing, they haven't got a new norm. It's not a new magic trick that has happened. These mortgages are not magically new. The Federal Reserve, the bank, the Fed cannot just support the housing market forever by just basically doing things in order to support or extend the housing market. And once the decline of a bubble that has been propped up for a long period of time starts to decline, you get that cascade effect that can happen, that panic kind of thing that can happen. and that could result in a massive downturn. So housing prices would decline 19% from 2007 to 2009, and mass mortgage defaults would lead to millions of foreclosures over the next few years. So once you have that decline starting, then of course housing prices go down rapidly. You end up with situations, especially because there was no money down for a lot of them. They didn't have the same down payments, where people were underwater, their loans being higher than the amount of the home value, and therefore even if the bank forecloses on them, they would not be able to sell the home in order to pay off the loan. And note that the banks are not really in the industry of selling homes. They don't want to foreclose, right? Because they're only putting the home as collateral to make sure to hold you to the fire, to make sure that you make the payments. And usually the second factor would be that you had a down payment down and are invested in the home. You have equity in it. If you have no equity in the home, because now you didn't put any down payment down, and the value of the home goes down so that it's lower than the value of the loan, then people start to say, hey, why don't I just walk away, from the home, and this kind, and of course that leads to more problems and so on. You got that cascading effect down. Now, obviously, over time, things will kind of work itself out over time, but there's a longer kind of recovery possibly from a decline like that, as opposed to a typical kind of stock market decline, bubble bursting and then kind of bouncing back up. It could have more long-lasting effects. And again, as the increase happens, as the time frame between bubbles can be longer, which means it's a lot easier for us to just kind of forget what was before that things could actually go down. We get the euphoric feeling of this is the new norm and nothing's ever going to go down. So we got to make sure that we keep the risk of a decline in our minds and keep that into consideration with regards to our investment strategy, looking at it from a national standpoint, and then trying to figure out our niche on the local level that makes sense within that context. So once again, referencing Investopedia, Housing Bubble by Hans Daniel Jasperson, reviewed by Hadika Hartit on December 25th, 2020. You can take a look at there to continue your research, noting that as time passes, you might want to take a look at Investopedia and see things as they update. They do update things from time to time, and continue your references and research from there.